Hey everyone, in today's video, I'm going to be talking about what might seem like a surprising topic to some of you, and that's talking through the downsides of guaranteed income. Now, for many, guaranteed income just seems like a plus. After all, it's a paycheck that you receive each and every month. It's guaranteed, it's dependable, and in today's complexities of retirement where one variable affects 30 other variables, and in this low interest rate environment where it seems like it's very difficult to gain a safe income stream, it seems like guaranteed income is more attractive than ever. Well, in today's video, we're going to be talking about why guaranteed income can sometimes cost your retirement more than it helps at times. Now, when I talk about guaranteed income, I'm not talking about Social Security. Okay, I'm not talking about a inflation-protected government pension. I'm talking about things outside of that. Mainly what I'm going to be talking about today are income annuities, the downsides of some of those income annuities, not from the actual product standpoint, but actually from the guaranteed income coming in. I'm going to be talking about pensions where you have an option to lump sum the pension or take the monthly option. And then I'm going to be touching a little bit on rental income as well. So if this is your first time watching our Safeguard Wealth Management YouTube channel, or maybe you've watched a few videos, first of all, thanks for being part of our community. We release videos multiple times per week. And if you want to make sure you're notified of all future videos that we release, make sure you hit the subscribe button, hit the like button below if you like this video, and let me know if you've considered guaranteed income and why you did go with that guaranteed income option versus not going with that income option in the comments below. I'd love to hear about your experiences. So let's hit the ground running. There's an important principle that I first want to lay the foundation for when we talk through really tax planning in general in retirement, but it's really going to come into these discussions with guaranteed income. Now, the thing with retirement tax planning is at the end of the day, we want optionality, meaning that we have multiple tax buckets. Each of those tax buckets carries a different tax rate. And at any point in retirement, there may be certain hurdles that show up that may not be there later in retirement, okay? And again, we want the optionality to take from the given tax bucket that benefits us most in that given year. And so this principle is you want to take income. And typically when we're taking income, we're creating a taxable event. So you want to take income when you choose, when it's best for your situation, not when you're forced. Now, this is going to come up throughout this video because at the end of the day, guaranteed income is forced income. Now, that doesn't mean that you should turn down a pension, that if you purchase an income annuity and turn down that income annuity, that you should forego income altogether and, basically end that annuity. What I'm saying is guaranteed income can often be a negative to your tax planning situation because it's forced income, for the same reason that RMDs are a negative, because it's forced income. We want to take income when we choose, when it's best for our situation. So let's talk about what type of guaranteed income we're going to primarily be touching on, and that's pensions and income annuities. So pensions where you have the option to take the lump sum versus taking that monthly option. If you have a pension that you can only take the monthly option, a lot of this is going to be a moot point. We're also going to be talking about income annuities. These are obviously purchased typically by investors. Now, another forced income stream that we won't directly talk about, but applies to some of these same principles, is also rental income. So again, if you have rental income coming in, again, that's not necessarily guaranteed, but some of the same principles apply when we talk through certain drawbacks of guaranteed income. So the first drawback that we'll talk about is tax planning. And again, remembering that principle that we want to take from those tax buckets when we decide. Now, we could talk about a lot of different tax hurdles that you want to avoid in retirement. We're going to be focusing right now on the Social Security tax torpedo because it applies so broadly to so many individuals. Okay, but there are a lot of other hurdles that we could discuss as well that, again, guaranteed income can hurt, such as trying to earn an Obamacare subsidy prior to 65. Such as trying to avoid different capital gain bump zones down the road, trying to make sure you don't make too much income or have too much income in a given year to push your Medicare premiums up, different hurdles like that. But let's focus on the Social Security tax torpedo. So kind of to lay the groundwork, if you're not sure how Social Security is taxed or how the Social Security tax torpedo is created, I'm going to link to two videos up in the right-hand corner that kind of describe both of these things that I will be talking about in this given drawback right here. But basically, to lay the foundation, as you take income from taxable income sources, it moves more of your Social Security benefit into being taxed, anywhere between 50 to 85%, depending on what threshold you're at based on something called your provisional income. So in layman's terms, basically, as you take more income from taxable income sources, it makes more of your Social Security benefit taxed. as you're pulling in $1 from other sources, it might actually turn $1.50 or $1.85 into being taxed. So what you'll see are marginal brackets increase by 50 to 85%. So let's look at what this looks like for a single filer. Now, everyone's Social Security tax torpedo graph will look different based on how much they have coming in from Social Security. Okay, so how you read this graph is you look at the x-axis. This would be income coming in from taxable sources. So traditional IRA withdrawals, pension income, annuities, if those are IRA annuities, any income from that source, capital gains, things like that would all be taxable income. Okay, then on the y-axis, we have marginal tax brackets. And you'll see this red line right here is intuitively what you think you're taxed at. So that would be the normal brackets, 10, 12, 22, 24. And in the blue, we have what you will actually be taxed at. So this single filer has $36,000 coming from Social Security. And let's say that they want to go out and purchase a $30,000 annuity, providing $30,000 of income throughout their life annually. So if we go down here on this chart, okay, we can see that if they were purchasing a $30,000 annuity, that $30,000 would be forced income. At the very least, this is where they would fall on this Social Security tax torpedo, assuming they didn't have any other income that was forced, any pensions, anything like that. Well, we can see based on their Social Security tax torpedo that this automatically puts them right in the 22.2% bracket. Now, the income up to this, underneath the standard deduction, some of this annuity is actually filling up the standard deduction. Again, it's forcing some Social Security benefit into being taxed, but all of that is underneath the standard deduction. A little bit is being taxed at 15 and 18.5% right here. But then finally, they're being pushed into the 22.2% bracket. Now, this might not be the end of the world based on their forward-looking tax plan. Again, it all depends on what they otherwise could be taxed at in the future. Now, if they could completely avoid this 22.2% bracket, we see that this forced income is making them a little bit tax inefficient. The other thing to note is the thresholds that determine how much of your Social Security benefit is taxed are not adjusted to inflation. So what you will see over time, what this retiree will see over time, is this 40.7% zone that they want to avoid at all costs is going to slowly move over here, and their annuity income is likely going to be pushed into this zone at some point. Again, because those thresholds don't adjust to inflation. Let's look at a married filer. Okay, let's say that they have $40,000 that's coming in from a pension that they have the option to either lump sum that pension or take that as monthly income. Now, they have $64,000 coming in from Social Security benefits. And again, we see the same chart, only we see at this point in 2026. What happens in 2026? Tax Cuts and Jobs Act expires. The 12% bracket turns into the 15, 22 turns into the 25. So you'll see these marginal brackets here rise once again because of the starting bracket rising. At $40,000 of pension income, if they took the monthly pension option, once again, we see the same thing playing out. Sure, the initial part of their pension would fill some of these lower brackets here. Okay, but the majority of their pension here, or a good part of their pension, is going to be taxed at 27.75%. Now again, this all matters relative to their forward-looking tax plan. Is 27.75% the best they're going to be able to do? Or are they trying to wipe out all of their other IRA accounts to avoid RMDs? Then this income might not be a large drawback. But depending on if they could set up their situation, and they likely can, to avoid this 27.75% altogether, they are paying higher marginal rates on that forced income that they otherwise could have the optionality on. So again, what might that look like? Well, they would convert, before filing for Social Security, they would convert most of their IRA assets, and they would just pull from, essentially over this mark, they would be pulling from taxable accounts, or they would be pulling from Roth IRAs to avoid this altogether. So again, forced income typically in retirement is oftentimes a drawback when we talk about tax planning. Let's go through drawback number 2. Now, this is typically a drawback when you have that forced income that doesn't adjust to inflation. So we know each and every year the dollar is devaluing because of inflation. So each and every year you need income raises to keep up with the same purchasing power as you had the previous year. And we know since the start of the 1900s, basically a dollar today is worth $26 in the year 1900. So we've seen a dollar devalue greatly over the last century. Now, when we think of a pension or an annuity that doesn't have those built-in inflation adjustments, what we're going to see over time is the value of that guaranteed income is vastly different at the start of retirement versus at the end of retirement, and obviously then throughout retirement. So this is someone needing $95,000 of starting income, and let's say they have a $25,000 guaranteed income annuity. Well, at the beginning of their retirement, that guaranteed income covers 26% of their income need. But as we see throughout retirement, they're going to need to basically take an income higher than $95,000 because they'll need those raises because of inflation. Now, Social Security in and of itself is fantastic because it has built-in inflation protections. So do some pensions. But a lot of income annuities and most pensions don't have that inflation adjustment. So what we'll see through this person's 30-year retirement, that income annuity becomes less and less valuable. By the end of this 30-year retirement, this income annuity is covering less than 12% of their income need. And so it devalues over time. We also need to be thinking about that. If you purchase an annuity at the beginning of retirement, it's going to look a lot more attractive than it does from at year 5, 10, 15, 20, and even 30. Okay, and finally, drawback number 3 is opportunity cost. So again, we need to be looking at everything in retirement first through a tax lens, but then secondly, what is the opportunity cost of that decision? So with many pensions, you have the opportunity to take a monthly income, essentially an annuity pension option, versus a lump sum. The same thing is obviously true when you purchase an income annuity. You are taking a certain level of your assets and going out and purchasing a monthly income stream. So how valuable is that monthly income stream? Well, this is going to vary widely. You can plug these numbers into a present value calculator that shows the present value of each of these options. You can upload an investment return. You can add on, if there is an inflation protection, you can add that into a lot of these calculators as well. But this was an analysis I did for a client that is 55 years old, and she's looking at $1,042 monthly pension option versus a $335,000 lump sum. And plugging this into this present value calculator, we see that at a measly 3% return on her money, she would have to live to the age of 111 or older for the monthly income to overcome this $335,000 lump sum pension. Now, again, this is obviously assuming we take that $335,000 lump sum pension and invest it at 3% per year. Now, if we look at 4% per year, essentially she would have to live to over 120, okay? So obviously in this scenario, and again, this depends on how you're invested. For a retiree that has the majority of their money in cash and they can't stand potentially losing money, well, maybe 3% is a high hurdle rate. Maybe the monthly pension option does make sense at that point. But for the vast majority of retirees in a diversified portfolio, earning 3% I think is a very low hurdle rate. Let's go through another one. This was for a gentleman, same age, 55, and he could either take a pension of $3,600 a month or an $876,000 lump sum. And you'll notice every pension has a different present value. So again, I urge everyone to plug their options into a present value calculator or have someone do that for them and talk through the benefits and drawbacks. But their pension was a little bit better relative to the lump sum. And so here we're showing a 4% per year return on that lump sum, and they would basically have to live till age 96 or older. Okay, if we look at 5%, I believe this was 110 or older. So start plugging in some different investment returns and figure out what your hurdle rate is and see if that's reasonable relative to your investment portfolio. A lot of times we see the lump sums make a lot more sense. A lot of times we see not purchasing that income annuity because of inflation protections and looking at the low hurdle rate and looking at the tax implications. They typically don't make sense. Now, I'm not making the case that guaranteed income is always bad. We have to be looking both at the quantitative side as well as the qualitative side. So at times, if that provides you more peace of mind, just from a qualitative side, maybe it's worth it. Now, we are personally not very big fans of income annuities for a bunch of different reasons. We'll record additional videos on that outside of some of these things we talked about in this video. Now, hopefully this video was informative to show some of the downsides of guaranteed income. Oftentimes I find we're only told about the upsides of guaranteed income, only told about all the nice things of guaranteed income. Now, with income annuities, we typically know why that's the case, but nonetheless, there are some downsides we need to be thinking about. We need to be looking at the tax planning perspective of it. We need to be looking at, does this income that we're receiving, is it devalued over time because of inflation? And then finally, what is the opportunity cost that we could otherwise be earning, okay? And always remember, you don't need more money, you need a better plan. Hopefully this was an informational video. If you like this video, make sure you hit the like button down below, leave a comment, and hit the subscribe button. We greatly appreciate it, and we will see you in the next video. Have a great rest of the day.